Hi everyone, welcome back to the channel. My name is Dhaval Gangar and this is my YouTube channel, The 1% Common Sense, where I uncover simple yet effective common sense habits and practices applied by the richest 1% of the world to create generational wealth. In our last video, we went over an easy 6-step process to create financial plan, and we learned number 1, how to optimize your cash flow, number 2, prioritize your spending to invest and spend guilt-free, and number 3, realize the power of planning and executing. Watch out the link in the description below to watch that video. In our video today, we are going to uncover an economic development that happened in last month, and we will learn how it impacts you and real estate in particular. In our monthly market video update, from now on, I'm going to cover an interesting long-term trend that may impact the way we live. So please stay till the end. Let's dive in. Here are the top 5 economic headlines of the month. Number 1, Canada's unemployment rate reaches 6.6% and rises past 7-year high outside of pandemic. Number 2, Canada's inflation rate reduces to 2.5% in July 2024. Number 3, Bank of Canada announces another rate cut in its September 2024 policy meeting. Number 4, the US continues to witness higher unemployment and lower inflation rate. And number 5, decline in housing sales and prices across Canada. The economic development of the past month reiterates my thoughts shared in my last video. Canada's unemployment rate has reached 6.6% in August 24 versus 6.4% in July 24. This in fact is the 7-year high excluding the pandemic high. Canada is well on course to reach the unemployment rate of 7%. In fact, if you drill down the details of the employment number, you would realize that though Canada added net 22,000 new jobs, but they all came from part-time jobs which increased by 66,000, whereas the full-time jobs saw a decline of 44,000. Once again, strong population growth swamped the modest growth witnessed by the part-time jobs in Canada. Canada is adding more than 100,000 individuals month over month, a trend which we have been witnessing for more than 3 years now. Though the federal government has announced some changes to its resident and non-resident immigration policy, but this trend will take some time to slow down, and hence it will continue to feed in to high unemployment rate. On the inflation front, Canadian CPI, a measure of inflation, has seen month-over-month reduction, and it was at 2.5% in July 24 versus 2.7% in June 24. A reduction in inflation has been caused by the items which are in direct control of the consumer, such as expenses on travel, telephone services, and passenger vehicles, whereas the upward pressure on inflation was kept by the items which are not in direct control of the consumer, such as mortgage interest cost, rents, insurance, and gasoline prices. However, if you observe, the prices of gasoline has already seen a reduction since the beginning of the year, and I will cover that in further detail later in the video. The prices of rents have moderated, and mortgage interest costs should see reduction as we witness more interest rate cuts by Bank of Canada. On September 4, Bank of Canada's interest rate announcement, Governor McCallum characterized Canada's economy as having enough slack built. So, big news number 3, and not a surprise, Bank of Canada reduces interest rate by 25 basis points in its September meet. A further weakening in the job market and reduction in inflation should encourage Bank of Canada to reduce rates by 25 basis points each in its October and December meet. In fact, the interest rates in Canada are well on course to be below 3% by the end of 2025, a time period when the majority of the mortgages are up for renewal. Isn't the script well played out to avoid the biggest financial stress in the economy? The story of the weak employment and low inflation rate is similar in the United States. In fact, if you adjust for the population growth, the unemployment rate is more impactful as more number of people have lost job in the United States. In August 24, the permanent job losers were at 1.7 million, that is 44% higher than the post-pandemic bottom of 1.2 million in September 2022. Talking specifically of GTA market, units sold are down by 5% year over year and months of inventory has been rising. However, it's important to break this into types of properties, and we could see that condo apartment sales are down 11%, whereas while single houses sales are down only about 4 to 5%. The condo apartment has started to see accelerating price pressure with prices down around 5% year over year. Watch out my video on the rise and fall of the condo apartment market and what's next for the condo apartment market. I've covered some interesting insights in these videos. In all, active listings are up 46% year over year in the month of August. It is in fact at the highest level in the month of August in past 1 decade. So what's next for the real estate market? In my view, we would continue to see the weakness for the rest of the year, and it provides a great bargain for the one who looking to enter into the market, as the spring of 2025 might see increase in the buyer's activity as interest rate drops to 3.5% range. In my view, freehold properties would see demand recovery faster than the condo apartment market. As promised, here is the one interesting long-term trend that may impact the way we live. Just the days after crude oil prices slipped under $74 a barrel, erasing all the gains it witnessed in 2024, the member nation of oil-producing cartel, OPEC Plus, agreed to delay increase in production further by 2 months to prop up the prices. The oil prices are driven by 3 main factors. First, current economic environment. Second, geopolitical tension. These two drive the short to medium term price outlook, whereas third, the supply and production of the oil drives the long-term trend for the oil prices. With China's economic struggle post-pandemic and the likely slowdown in the United States has led to a fall in the oil price since the beginning of 2024. But that's all priced in, and that's why the oil cartel OPEC Plus has been trying to curb the production and supply of the oil to prop up the price since past 1 year now. But that led to an interesting trend. We have observed that market share of the OPEC Plus has synced to all-time low as rival United States, Canada, Mexico and Guyana take hold of the production. The trend which is most likely to continue in the next couple of years. So how does it impact you? Quite visibly. Any decline in the production by the OPEC Plus countries to prop up prices could be aggressively countered by the increase in production by the non-OPEC Plus countries led by the United States. This in the short term might be positive for global inflation as it will keep the prices of oil in check. However, in the long term, the suppressed oil prices could propel an increase in the global tensions and conflicts to serve the interests of the ones who want oil prices to increase. With that thought, I'm signing off for today. Please like, share and subscribe to my YouTube channel, and I hope to see you all next week. Until then, take care.